Have you ever caught yourself pondering over what covered call ETFs are? Maybe you're captured by the potential benefits they may serve. In the intricate landscape of finance, tools like these are progressively gaining popularity due to their capability to generate possible income and lessen risk. But, to fully grasp their comprehensive capabilities and uses, let's initially decode and concepts associated with them. Let's begin with ETF, an acronym for an exchange-traded fund. This is a type of investment fund and an exchange-traded product which is purchased and sold on stock exchanges, the very same platforms where you would trade individual stocks. Picture it as a hybrid of individual stocks and mutual funds, incorporating the defining characteristics of both these financial substances. However, an ETF is not merely a simple fund. It embodies a massive, diversified collection of various assets that are traded like a single stock. These assets could encompass a compilation of stocks, commodities like gold or oil, bonds, or even all of these combined. For example, imagine we have an ETF made up of tech stocks. So instead of buying individual shares in Apple, Google, and Microsoft, an investor would just buy the ETF. This diversification enables investors to invest in a broad sector or industry without the need to purchase each individual stock, commodity, or bond. The shares of an ETF trade akin to stocks, with their value oscillating throughout the day as they are bought and sold. Furthermore, they trade close to the net asset value of their underlying assets over the course of the trading day. That implies that the price you pay for an ETF is almost equivalent to the total net worth of all the assets it holds. This is a compelling mechanism, one that provides immense potential for those who can master it. Shifting focus to covered calls, it's a financial market transaction where the owner of the assets sells call options on the same assets to generate additional income. This approach is frequently adopted by investors who speculate a neutral or slightly bullish market. In essence, a covered call strategy is a dual-faceted approach. It necessitates owning or buying shares of stock or ETFs, and then selling call options against those shares. As an illustration, if an investor owns 100 shares of a company and believes the stock price might remain relatively stable in the near term, they might sell a call option for those shares, collecting the premium. The strategy is termed covered because the owner of the assets possesses the necessary quantity of the underlying asset to deliver if the call option is executed. The sale of these options generates an income for the holder, acting as a form of premium. This premium serves as the primary source of income and potential profit for investors using this strategy. However, it's crucial to note that this strategy necessitates a thorough understanding of the derivatives market, as options trading can be complex and risky. So essentially, a covered call ETF is an exchange-traded fund that employs a covered call strategy to generate income from the option premium. To put it in layman's terms, it's an ETF that owns a portfolio of stocks and then sells call options on those stocks. This strategy carries a level of risk because the ETF is obligated to sell the underlying stocks if the options are exercised. However, it also offers the chance for income generation through the premiums received from selling the options. To simplify, a covered call ETF is a sophisticated financial mechanism that can offer potential income and mitigate risk when employed correctly. However, like any financial instrument, it demands a profound understanding of the markets and the strategies involved. If you're contemplating investing in a covered call ETF, it's crucial to research thoroughly and, if feasible, seek advice from a financial advisor. In conclusion, a covered call ETF is an exchange-traded fund that utilizes a covered call strategy to generate income from the option premium. This strategy involves the ETF owning a portfolio of stocks and then selling call options on that portfolio. If executed correctly, it can provide a steady stream of income for investors, while also offering the potential for capital appreciation. Let's delve deeper into the benefits of covered call ETFs. These financial tools are an extraordinary facet of the financial sector that investors can exploit to reach their financial targets. Serving a unique purpose in the considerable universe of investment options, these exchange-traded funds carve out a distinct pathway for income generation. This is particularly advantageous for those who lean towards a more cautious investment approach or are on the hunt for significant income levels. Take this for instance, covered call ETFs are engineered to provide a safety net in the event of market downturns. This buffer is established through a methodical process that involves gathering premiums from the call options sold. These premiums act as a monetary safeguard, buffering against potential losses if the underlying stocks within the ETF drop in value. Imagine it as having a safety parachute while skydiving. It's there to protect you if things don't go as planned. The appeal of covered call ETFs doesn't end there. An inherent feature of these funds is their ability to dampen portfolio volatility. Picture this. In the financial realm, volatility is similar to a roller coaster ride. The ups and downs represent the price variations of a financial instrument over time. High volatility often spells higher risk for investors, reflecting a greater level of unpredictability in the market's direction. Hence, by lowering portfolio volatility, covered call ETFs function like a soothing balm, offering a degree of tranquility amidst the chaos. Furthermore, these ETFs present investors with a means to tap into the potential benefits of stock ownership. For example, they enable participation in the growth of the stock market while softening the risk. This is like having a piece of an ever-growing pie while wearing an oven mitt to protect against potential burns. However, one must not forget that the income generated from selling call options might limit potential benefits if the stock prices soar drastically. This is a trade-off that investors must weigh thoughtfully. Covered call ETFs also simplify what might otherwise be a complex process. Through these ETFs, investors gain access to strategies formerly reserved for the financial elite. This democratization of advanced investment strategies can be a game changer, akin to unveiling a secret recipe to a wider audience, enabling many to amplify their investment's potential. However, like selecting the right ingredients for a recipe, it's vital to assess your risk appetite when investing. This involves a comprehensive understanding of your financial health, your investment objectives, and your resilience to potential losses. Remember, no investment strategy is foolproof, and every type of investment carries inherent risks. Therefore, due diligence is key when diving into any investment decision, especially ones involving covered call ETFs. In conclusion, covered call ETFs can serve as a great tool in a well-diversified investment portfolio, simplifying complex and providing access to strategies previously limited to sophisticated traders. However, it's important to consider your risk tolerance and investment goals before diving in. Thus, this more detailed introduction to covered call ETFs has shed light on their benefits, function, and the potential advantages they offer. But always remember, as with all investments, thorough research and careful consideration are prerequisites before making any investment decisions.